Welcome back to Investing Uncomplicated for everyday investors, where I make your money and the market make sense. Y'all know I created this channel for the everyday person who wants to invest in the stock market. One of the most consistent questions that I get is, Courtney, should I be investing in individual stocks or mutual funds? And then they follow that up and they say, and by the way, like, what's the difference between a mutual fund, an index fund, and an ETF? Courtney, help me figure out where my money needs to go. My people, my family. Y'all know your boy got you. So that's what we're going to talk about today. We're going to talk about the difference between stocks and mutual funds. And then we're going to talk about these subcategories of mutual funds, including index funds and ETFs, and what may make the most sense for your money in the market. So first, let's talk about individual stocks. I think we have an idea of what an individual stock is, but let's cover it real quick. So when you buy an individual stock, you are actually buying a share or a piece of a company. You are a partial owner in a company like a Google, like an Amazon. When you buy that share, you are part owner. Think of that company as a pizza. And when you buy a piece of that company, you're buying a slice of the pizza. Now, here are the benefits from buying an individual stock. So the first benefit to buying an individual stock is that you can make money in two different ways. The first way is through price appreciation. The second way is through dividends. So when you buy that piece of the pizza, you pay a price for that, right? That piece of pizza costs money. The goal is for the price of that piece of pizza to cost more at some point in the future. You got that part. Like, that's making money through price appreciation. The second piece is through dividends. So as an owner, if the company makes money, some companies pay out a portion of their profits to their shareholders. Okay, that portion of profits is called dividends. So because you're a partial owner, you get to participate in the profits. That's the second way you make money. An advantage of investing in individual stocks is that they traditionally, especially when it's a really, really good company, they can go up in value faster than a mutual fund, but there is more risk. So let me give you this fundamental principle about investing. And this isn't just investing in the stock market. This is investing in real estate or anything else where you may commit your money with the expectation of some return. The higher the potential reward of the investment, the higher the risk. They work together. So when you talk about individual stocks, because they can achieve higher returns, they are also more risky. So the bad part of that is when you invest in individual stocks, let's say you put $500 into a company like Microsoft, and Microsoft stock goes from $200 to $100, you've now lost 50% of your investment. Now, we know that when we don't actually sell that stock at a loss, it's an unrealized gain. And so at some point in the future, that price can come back. But we have to be patient and wait for that to happen. For some investors, the volatility of individual stocks may be a lot for them to handle emotionally. So it may make sense for them to look for a more diverse investment that doesn't have as much volatility. And by volatility, I mean the ups and downs in the price. So then you may ask, well, should I be investing in individual stocks? Or better yet, who should be investing in individual stocks? Look, you're here, you're a part of the Investing Uncomplicated community because you want to learn to invest the right way. And I give you the strategies to be able to do that. I'll admit, individual stocks are more volatile. But if you're tapped into this community, if you are learning for me, I teach you patience when the market gets tricky. Okay, we know that throughout history, there are ups and downs in the market. But when you hold through those down times, the market always rises to the occasion. And the occasion is the point where you make more money. If you learn in this community, if you know to be patient, then you can ride the ebbs and flows of the market. Now, some people can't. And so if you can't, you don't want to invest in individual stocks. Now, let's talk about mutual funds. A mutual fund is basically a basket of individual stocks. If you've attended my free class, maybe you've seen me on YouTube or you've been following me on social media, you know my thing is making the stock market make sense for the everyday person. But look, there's a difference between just understanding the concepts and applying what you learn. That life you want to live, that lifestyle you want, making your money grow, that comes from application and not just learning. And that's why I created the 5-week investing challenge. Make your future self proud. Go ahead and click the link, join the class, and I'll see you on Wednesdays. So instead of just buying one share of one company, you are buying a piece of a basket of a lot of companies. A mutual fund can have hundreds, and in some cases, thousands of companies within one investment. Now, when you buy a share of a mutual fund, you're not buying ownership the same way you are with the individual stock, but you do get the benefits of the price appreciation. Mutual funds move in the same way as individual stocks, based on the value of the companies that are within the mutual fund. Mutual funds are viewed to be a little bit more safer historically than an individual stock. So using the example I gave you a moment ago is like if you invest in Microsoft and its stock price goes from $200 to $100, well, you've lost 50% of your investment. But if you own a mutual fund and it has hundreds of companies in it, and Microsoft is one of those hundreds of companies, and Microsoft value goes down 50%, your overall portfolio is not impacted as much. And you hear things like, oh, well, that naturally sounds like a better investment. Well, there are pros and cons of both, because let me tell you this. I mentioned earlier, there's a direct relationship between potential returns and risk. So now we're talking about mutual funds where there is a lower amount of risk. So if there's a lower amount of risk, what does that mean for your potential returns? You got it. The potential returns are lower as well. So you are in essence sacrificing the potential returns for a little bit more safety. So now you're like, all right, Courtney, so I see what you're saying about mutual funds, but you said index funds and ETFs. What are those? Let me start with an index fund. An index fund is a type of mutual fund that does not have a fund manager. The reason why it doesn't have a fund manager is because the companies that are in the index fund, it mirrors one of our indexes. Think about the S&P 500 or the NASDAQ, even the Dow Jones or the Russell 1000. These are all indexes that we use as a gauge to determine how the overall market is performing. So because these indexes already have companies that are identified to be a part of them, companies allow you to just invest in the index themselves. So you may buy a S&P 500 index fund through Fidelity. All right. Now, when you do that, you are in essence investing in the performance of the S&P 500. Now, the one big difference between index funds and exchange traded funds is the way that you buy them and the price at which you buy them at. With an index fund, there's only one price that you pay in order to buy a share of that index. And that transaction only is processed at the end of the day. Whereas with an exchange traded fund or an ETF, these are actually traded on the market as if they were an individual stock. So for instance, if you wanted to buy VOO, which is Vanguard's S&P 500 ETF, you can buy it at any time of the day at whatever the market price is. So that market price changes thousands every millisecond, thousands of times throughout the day, right? It trades just like an individual stock, whereas an index fund has one closing price every day. For that reason, ETFs are actually easier to buy. So let's compare all three: mutual funds, index funds, and ETFs. So the good with mutual funds, they're professionally managed. You have an expert choosing the investments for you, so you don't have to worry about it. They're automatically diversified. All right. So for the people who are concerned about being over concentrated in one individual stock, you get that diversification automatically through the mutual fund. And then the third benefit of mutual funds is that they're lower risk because you have the professional manager and you have the diversification. The bad, the fees. More bad is the fees, and even more bad is the fees. The fees impact your ability for your money to be reinvested, compound, and grow. And that alone can be a deterrent. Also, you don't pick the companies that are in the mutual fund. So if you're a part of the Investing Uncomplicated community, and I'm talking about a stock that I believe in for the next 10 years, you may be buying a mutual fund that doesn't include that company. And so you can't invest in that company through that mutual fund. So you got to figure out another way. Sometimes mutual funds don't beat the market, and that's a drag, right? Our objective of tapping into resources is to perform better than the market. So there could be some mutual funds that may actually underperform. And then lastly, with most mutual funds, you can only buy and sell once a day. So let's talk about the good of index funds. Number one, super low fees. We don't have to worry about the fees that we have with the traditional mutual fund. Fees are much lower. Number two, historically, the indexes have performed really well. So when people talk about beating the market or underperforming the market, when you invest in an index fund, you are invested in the market. And historically, it has done 8 to 10% a year. There's no guesswork. You don't have to do the research. You don't have to find the companies. You don't have to think about when to enter or when to exit. That work is done for you already. And the only way that you completely lose your money in an index fund is if the entire economy collapses. And the chances of that happening are pretty rare. Now, here's the bad. The bad looks a little bit like the good. You can never beat the market because you are invested in the market. It can be a little bit boring. You're watching YouTube videos about the stock market. You're following people on social media. You're listening to podcasts. You do that because you want the secrets. You want the sauce. You want the strategies, right, to do better. And when you're invested in index funds, you don't get that at all. So it can be a little bit of a drag. So now let's talk about ETFs. The benefit of ETFs is it's kind of like the best of both worlds. You get the liquidity because the ETFs, you can buy them and sell them the same way you would an individual stock. They're low fees. There's no guesswork for you, and you can buy an ETF that tracks just about anything, any industry. If you want a financial ETF, it's out there. If you want an ETF that mimics the S&P 500, there's one. If you want an ETF that looks like the semiconductor industry, you can do that as well. There's no one size fits all. You can invest in the industries that you like, low fees, lots of liquidity, lots of variety. Now, the bad of ETFs, because of the liquidity of ETFs, it could entice you to buy and sell more than is absolutely necessary. Because there are so many different ETFs, you could also find yourself investing in some things that may be more risky than your risk assessment may necessarily tolerate. And if you are trading more frequently than you normally would, you could subject yourself to more fees, which kind of defeats the purpose, right? Because we're investing in ETFs because we want to avoid the management fees of mutual funds. Here, as a quick bonus, I just wanted to share with you all a few of the ETFs that I like. And the reason why I want to do this is because me personally, with my money, I invest in individual stocks and ETFs. I don't own any mutual funds. I don't own any index funds. I like the liquidity and the specialization of ETFs, and I tend to keep my money 50-50, 50% in stocks, 50% in ETFs. So as an additional bonus for making it this far in the video, I want to share with you my favorite ETFs. All right, number one, VOO. This is Vanguard's S&P 500 ETF. QQQM. This is the NASDAQ in ETF. This is the top 100 tech companies that are traded on the stock market. And number three, SMH. SMH, this is the semiconductor ETF. So if you're a beginner and you're looking for a place to start investing, you may think that you're not necessarily ready for individual stocks. You definitely have heard some things in this video that makes you not want to invest in mutual funds or index funds, but you think ETFs may be the best place for you to start. These are 3 that you can get started with. All right, guys, now you have it. One of the top questions that you've had that has been keeping you from investing in the stock market, you now have the answer. You know the difference between individual stocks, index funds, mutual funds, and ETFs. So you may be wondering, Courtney, well, how should I invest my money? You first have to do some self-evaluation. Okay, let me give y'all this game. The stock market goes up over time. In between time, there will be downturns. You will see your money in some instances go down in value. Some of the companies that we felt like are the most valuable and the best stocks that we could ever own, they'll have bad years. But it's important to know that the longer you stay in the market, the more money you will make. And you may sit here and be like, Courtney, I got it. I just need to hold on to whatever I invest. That's exactly right. But I'm gonna be real with you. It's easier said than done. So you have to ask yourself, do you have the patience, the peace, and the self-control to see the value of your money go down in a down market? And we normally put this on a spectrum of like 1 to 10. 10 being, yes, I can handle the fluctuations in prices and value. 1 being, no way, Jose, I need my money to stay consistent. If you're somewhere above 5, you can own some individual stocks. If you're somewhere below 5, you need to stick with ETFs and mutual funds. I can't give you an exact percentage because I don't know you guys personally, and everybody's gonna have a different risk profile. But what I do encourage you to do is to look back, look at the history of the market and how it's performed over time. So you get the reassurance to hold on to your investments during downturns in the market. The better you are at that, the more ready you will be to invest in individual stocks. You can build a 7-figure portfolio and never own an individual stock. Let me say that for you one more time. You can absolutely build a 7-figure portfolio and never own an individual stock. It definitely requires more consistency, more patience, and it may be a little boring, but you can do it. So my objective is not to make you buy individual stocks. My goal is to teach you the different ways that you can build that 7-figure portfolio. So do the personal reflection, figure out the combination and the weighting that works best for you, and do that. All right, guys, look, that's it for stocks, mutual funds, ETFs, and index funds. Make sure you drop any questions or comments that you have below. If you learned something, share it with somebody that you love. Be sure you subscribe, share, and I'll see you in the next video.